Jennifer, you are live.
Right. Thank you. Hello, NorCal. Happy Friday. Great to see you all virtually. This is our new normal at the moment to get the best information out to you guys all at the same time. So thank you for logging on. Just a couple quick things. We are recording this. So take notes as we go along, but just know that we will be sending this out afterwards. You can watch it again. So we are recording. And then we are going to leave time at the end for some questions. So feel free throughout the presentation to go into the Q&A, and we'll get to as many questions at the end as we can. So welcome to our second economic update that we've done this year. We are thrilled to have Jordan Levine with us again. He's the Vice President and Chief Economist for C.A.R. Jordan was with us last year, also was with us in April, and he and I were talking, and oh my goodness, so much has changed since April, so we had to have him back. He's got a 2023 economic forecast that he literally just presented at the annual C.A.R. conference yesterday. So this is hot off the press. We're one of the first people to see this, so we appreciate Jordan's time. I just want to tee this up a little bit. As things have changed, it has been fast and furious. I know setting the expectations with your clients has been a moving target. So just know that we are here to support the conversations you need to have. And while none of us have a crystal ball, the more we can really sync up on what's going on locally and nationally really does help the perspective, right? So just know the expertise you bring to your clients right now. Although the market is in flux, the thing that has not changed is the important role you play with your clients. And so knowledge is really powerful, and perspective is very powerful as well. So we hope that today gives you both of those things that you can take with you to ensure that you are counseling your clients in the very best way for a fourth quarter. So without further ado, again, we'll record this, put some questions, but I'm going to hand this over to Jordan. Thank you, Jordan, for being here.
Yeah, Jennifer, thank you so much for having me back. I always take that as a good sign that I didn't scare you off too bad. And actually, you all are the very first, so not even amongst the first. I haven't showed this to anybody except for our board at the annual conference. So I'm excited to be here to kind of roll out the new forecast. I also changed it up a little bit and loaded it down with a lot of NorCal data. I pretty much ran from Monterey all the way up to Sonoma, and then all the way as far east as Sacramento. So you'll see a lot of that good stuff in here. And I would argue, Jennifer hit the nail on the head, but I think, the trusted advisor role is even more important now than ever before. I think that with all the uncertainty and all of the scary headlines that, there's an even bigger role for us to play to help kind of cut through that. I think this is kind of where I think our clients are at, right? Is they're hyper zoomed in, hyper fixated on the latest headline that they read, whether it's, another bad inflation number or the fact that the Fed's, continuing this kind of aggressive war against inflation. And I think, in an environment like that, what it's really important for us to do as real estate professionals working with buyers and sellers out there is get them, zoomed out away from the big scary tusks and scales and stuff, and to see the whole picture, right? And what I want to do is try and build some context and not just focus on the numbers as we see them right now, but I want to kind of walk us back in time to 2020 and 2021. And, because we've been in a market that is just so incredibly red hot. And yes, the market is down now, but in some ways that's exactly what you would expect, after having been in a market that was so overheated, where we had so much excess demand, where we had barely any supply, where prices have gone up incredibly. We do certainly have macroeconomic challenges, and our forecast is that we will enter a modest recession in 2023. The good news is it's not 2008 all over again, and I think this is where the data can really be your friend, and I'll make sure Jennifer gets a copy of these slides, but just to kind of take a step back and stop worrying so much about what's going to happen over the next 6, 12, 18 months and start thinking about where you want to be at in the next 6, 12, 18 years, because that's really what housing is all about. And it's easy to get bogged down in kind of the scary headlines. And even when I put out my forecast, they latched on to like the most pessimistic part of it for the newspaper story that they ran. And yes, we have had, a really difficult time. If you go back to 2020, and this first part, I just want to show you 2020 and 2021, right? We lost almost 3 million jobs almost overnight, 2 months time. That's the fastest we've ever lost jobs in California. And yet we had this housing market that was like almost on fire, right? The housing market, unlike the broader economy, started to surge as we initially reopened after the initial shutdown back in March of 2020. And if you kind of try and figure out how does that work, right? How can we have such a terrible economy, the most job losses we've ever seen, and have a housing market that shoots through the roof? Well, I think this partially explains it. This is those 2.8 million jobs we lost, carved out across the broad sectors in California. And I've tried to color code these and probably done a terrible job, but the moral of the story was that most of the jobs that we lost were in these white categories. And if you kind of drill that down, what it means is that it was really a kind of shutdown related hit to the economy. In fact, the 4 lowest paying sectors are bars, our restaurants, our hotels, retail stores, all of our kind of service sector, whether it was nail salons or barbers or dry cleaners, bore about 2/3 of the brunt of that decline. In fact, if you look at what happened to our very highest paying sectors, right, the ones that are so concentrated in Northern California in particular, they were relatively insulated from the effects of the crisis. You could work at Twitter remotely, right? You could work at Google and keep that high wage job. In fact, in many cases, you didn't have to commute to the office anymore. You were getting stimulus checks deposited. You had a stock portfolio that shot through the roof, just like your home price did. And so even as there was a pretty significant shock to our overall system from a home buyer demand standpoint, most of the jobs were lost in categories that, the reality is a lot of those folks weren't, those aren't the industry sourcing most of the home buyers in California's housing market, and the very highest earning folks who are really driving home buyer demand even before the pandemic, again, were pretty protected from the crisis. So you had these folks at the top end of the income spectrum who are more viable home buyers, right? And with the affordability conditions that we have, who were in some cases doing even better than ever financially, despite the kind of macro hit, in the form of 2.8 million jobs. The other thing that we had that really kind of gave home buyer demand a kick in the pants over the last couple of years is remote work, right? That folks didn't have to commute, at least not every day, into those downtown employment corridors. And we see that that's actually still the case. This is fresh data out of our 2022 home buyer survey. We talked to about 1,100 home buyers who bought sometime in the last year, and asked how many of you guys work remote. And what you can see is that it's more than 2/3 of home buyers, even in 2022. And we've had a lot of folks actually go back to work that are still working remote. And this actually plays a big role in their decision to buy a home. In fact, 2/3 of the home buyers said that their ability to work remotely was a big factor that actually made them go out and buy last year, right? And I didn't bring the data just because I didn't want to kind of bore you with too much survey research, but if you ask that same 67% of folks who work remotely now, do you expect to work remotely in the future? It's like almost 100% of them expect to work at least part-time in the future. Now, we'll see how that goes in a recession. I don't think workers will feel as firmly in the driver's seat as they do right now, but remote work is another one of those factors on top of the kind of trend where those high income earners continue to do really well despite the pandemic, really helped to kind of create this unprecedented wave of home buyers that we saw flood into the market over the course of the last couple of years. Third major factor, and I can't understate the effect of this enough, is that the interest rate fell to an all-time low level. I said the lowest level in 50 years just because that's the only time frame we can download consistent mortgage rate data for, but it's the lowest ever that you can get from the Federal Reserve, right? We were running a mortgage rate there that was about 2.65%. So you had, a relatively insulated top end of the economic spectrum, yet the kind of added benefit of remote work, and then this huge boost to purchasing power, right? And actually just on the basis of rates falling from about 5% where they were at the start of the pandemic, or a little bit before the pandemic, down to 2.65%, that was like a 25-30% boost to what a consumer could actually go out and qualify for and still maintain that good debt to income ratio. So it was kind of a perfect storm when it came to just how kind of poised we were for this surge in home buyer demand. And indeed, you saw that play out in the mortgage applications. Again, this runs right up through 21 because I wanted us to get that backward looking perspective. But you can see mortgage applications also rose to their highest levels that we've seen in a decade, going all the way back to before the last financial crisis, right? So all of these factors really got folks out there asking their mortgage lenders, like, how can I get a home, right? And they were actually purchasing homes with these mortgage applications. This doesn't even include all the crazy amounts of refi activity that we had over the last couple of years. This is just straight up purchases. And you can see how high they were relative, not just to 2019, but again, as high as we've seen since the last housing cycle ran. And actually, it was a lot of folks going out there and getting their foot on the property ladder for the very first time. In fact, in 2020, we hit a 10-year high. Actually, I think it was a little more than 10 years for home ownership, right? Or first-time home buyers as a percent of the market, with almost 37% or a little over. And even as it came down a little bit in 21, it was still pretty much at a 9-year high for the last couple of years. So it was a lot of these high-income, long-term renters that took advantage of remote work and those super, hyper low interest rates to go out there and actually get their foot on the property ladder for the very first time. Jennifer and I were talking about it this morning before we started the call, just how the pandemic really made our homes more important to us than ever before, right? Not just that people wanted to get their own homes, but you need more space. You're spending so much time there. You're homeschooling your kids there. It's your gym. It's your bar. It's, had to check so many more boxes. And I think that's what you see borne out here with so many folks finally, after such a long time, a long period of economic growth, making that plunge into home ownership. But we also saw a lot of those high income earners, keep their primary residence, right? But then go out and buy a cabin in Tahoe, a cabin in Big Bear. They went out and bought a, house up at Bass Lake where they could fish all the time. And indeed, you see that those numbers have continued to go up since the start of the pandemic. We've had 3 consecutive years now where there's folks going out there and buying a lot of second homes. And again, through the lens of hyper low rates and the fact that I don't have to go to the office every day, lends itself to a lot of second vacation homes and second home purchases. And it wasn't all just in the outlying areas, although we did see places like Mammoth and Yosemite and stuff like that growing by 200% plus in 2020. But again, just unprecedented demand. People want to get into the housing market for the first time. People who already had housing want to go out and get even more real estate, right? And so just a huge surge that actually kind of really showed up for us when it comes to closed sales, right? Last year, we hit almost 445,000 units, which is the highest we've seen, going all the way back to 2009, right? So again, not just kind of doing okay, even though we're in the midst of a pandemic, but the best level of home sales that we've seen since the last housing cycle, right? Even with elevated unemployment, 2.8 million folks having lost their jobs, home sales continued to rise at a rapid clip. In fact, that was a double-digit pace last year. And one of the big reasons, right, is because the top end of the market, which again is consistent kind of with the view that top end of the economic spectrum was really punching above their weight as the stock market went through the roof and home prices went up. And most of those folks kept their jobs. That yes, we had about a 15-20% increase statewide in transactions, but that was because the top end of the market was doing just incredible amounts of growth. In fact, if you look back to 2020, about immediately after we reopened after the initial shutdown in March and April, right? June, July, August of 2020 was seeing like 1 to 2 million and 2 million plus, already growing by like 50, 60, even 100%. If you carry that all the way through to last summer in 2021, at one point in time, 2 million and up was growing by more than 300% on a year-to-year basis. And that's even after having that kind of 70, 80, 100% increase back in 2020. So it's really hard to overstate this kind of incredible resurgence in demand that really was concentrated at the top end of the market in particular, that led to this spectacular growth in overall home sales that we enjoyed over the last couple of years despite the pandemic, right? And you can kind of see that played out across Northern California, right? And this is that kind of 12 counties or whatever, from Monterey up to Sonoma and east to Sacramento. But you can see, partially in 2020, but certainly in 2021, we were posting 25, 30% growth pretty much across the board, right? And these are actually sorted from highest price to lowest price. So San Mateo, San Francisco, Santa Clara on the left. And you can kind of see that same pattern that we saw at the state level, right? Where those very high priced markets were doing really well in 2021 in particular, but pretty much broad-based growth across the board. At the same time that we had this kind of resurgence in demand, we also had a huge retrenchment on supply, right? Our unsold inventory index, which measures months of supply. So basically looking at how many homes get sold and then how many actives, pending or contingent, are still out there, and how long it would take us to burn through that remaining inventory at current rates of sales. We hit 1.2 months of supply. That's the lowest ever recorded since C.A.R. has been doing this. I'm only showing you the last 15, 20 years, but I can take this all the way back 30 years. You don't get 1.2 months of supply. And again, we had a pandemic, we had PED forms, masks, we had a lot of folks worried about getting sick and just didn't want people coming through their homes. And so, right at the time when demand was surging, we had a huge pullback on supply. And when you get that kind of conditions, it's not, economics 101 is going to tell you exactly what to expect there. And we saw incredible inflation to home prices over the course of the last couple of years. A lot of people have generated a lot of wealth and home equity, which also kind of helps to insulate us from some negative impacts of a modest recession next year, right? Most folks have significant home equity out there, but from a kind of market standpoint, right, when you have tons and tons of demand and not enough supply to go around, you see that the competitiveness out there was just unprecedented as well. If you go back to last summer, and again, just focusing for context sake on the last couple of years, the median time it was taking for a single family home to go from list to pending in California hit 7 days, right? And that's a median. That means that half the homes that we were closing last summer were going pending in less than 7 days. And I think we all kind of experienced that in one way or another. If you look at the state level, right, at one point in time last year, we were running about 3 out of every 4 homes that closed above list price, the highest numbers we've ever seen. So they were selling quick. Buyers had to really kind of highest, best, and fastest, right, to kind of get their offers accepted. You had a lot of folks who are willing to put lots of money down, pay cash, etc., to get their offer slid to the kind of front of the pile. And in Northern California, it was even more competitive than that, right? Not 3 out of 4. You're talking about 4.5 out of 5 homes closing above list price for a good portion of the last couple of years, right up through 2021 as well. And so it's no surprise then, right, when you have lots of demand, no supply, and these hyper low rates, that we kind of transferred a lot of this uptick in purchasing power from buyers to sellers in the form of higher offer prices, right? Because again, the market was so competitive. So I didn't just say, oh, we got a windfall from lower rates, let's go ahead and just save on our monthly payment. No, that enabled me to actually go out and offer more for the home to again get my offer slid to the kind of front of the pile. And at one point in time, and I know this is probably laughable for most parts of Northern California, but from the statewide perspective, a $900,000 median price is just absolutely incredible. And again, these are medians, right? So that means that 50% of what we closed last year was closing above, or above 900,000. And if you look at how that shakes out in Northern California, this is why I had said it's kind of laughable, but even in the quote unquote cheap areas are no longer very, very cheap. I know for somebody, sitting in San Mateo with a $2.1 million median price, the Sacramento 550 is cheap, but from the standpoint of pretty much any other part of the country, that's still a very expensive housing market, and that's kind of the lower end of what you get offered up there. What's interesting is that in 2022 so far, prices are still up on a year-to-year basis. They've started to slide a little bit in recent months, but when you aggregate up the whole year and you compare it, or at least the first 9 months of this year compared to where we were in 2021, prices are still fairly high relative to last year, right? So part of it is that we got this big inflationary curve, and part of it's just that we're coming back to normal, right? After having just such incredible growth, 10-year highs for mortgage applications, all-time lows for interest rates, the highest level of home sales in over 12 years. But part of it is this slowing down due to the Fed's kind of persistent war against inflation, right? And also the fact that they've been so far behind the curve. In fact, if you look at where most of those darts are landing, we continually see the Fed come out and have to backpedal, right? That if you go back to June, they thought they needed a Fed funds rate, I think, of about 3.8%. And then you go fast forward to the September meeting, and now they all of a sudden think we need a Fed funds rate of 4.6%. And so they've been, I think, overly optimistic about how successful they were going to be about getting inflation in check. And I think if you kind of model that trend forward, there's a chance that they're going to continue, to have to kind of stay aggressive. And this is already impacting us. This is kind of where the rubber meets the road in terms of super nerdy macroeconomic data having real life impacts for us in real estate, because you can see even actually before the Fed started raising the Fed funds rate, just when they said they were going to, we started to see the 10-year Treasury and the 30-year fixed rate mortgage really shoot up. And I just pulled fresh data this morning, and Freddie Mac's number for last week was a 6.92% average rate on a 30-year fixed rate mortgage, which I don't have to tell you all is significantly higher than where we were, even at the beginning of 2021, when again we were running a 2.65% mortgage rate. Things are up more than 400 basis points over the course of the last 18 months, and that has real implications, right? So I just took the kind of $900,000 median home price. We actually have a whole interest rate effect tool that you can go use on our website, where you can pick out your county and your kind of customer profile or whatever, if their income and debt to income ratios and all of that. But I just took the kind of median household or the median home here in California. And if you kind of go back to early 2021, when we had a 3% or even lower rate, the payment on that home was a little bit less than $4,100 a month. If you take that exact same home now and recrunch the numbers at a 7% mortgage rate, which we're on the kind of cusp of breaching, you're looking at a payment on that exact same home now of about $5,800 and some change, right? So you're talking about a $1,700 a month increase in mortgage payment for the exact same home, right? And realistically, how this is going to play out is it's going to mean that people don't qualify for as much as they used to, right? If you look at a kind of $150,000 a year generic household who wants to have, basically a 30 or so % debt to income ratio, they need a $3,700, $3,750 payment, right? Monthly mortgage payment. Well, at 3%, that equates to an $830,000 home. At 6%, though, it's only a $630,000 home, right? If we get to the kind of worst case scenario of an 8% mortgage rate, you're going to lose another $100,000. And this is for $150,000 a year income, right? So you can kind of scale that up or down depending on your needs. But the point being is that these folks that are kind of falling victim to the brother-in-law effect, right? That, oh, my brother-in-law told me there's going to be a big foreclosure crisis and I should just wait till next year and stuff. You could be really kind of shooting yourself in the foot, as it were, by facing even higher interest rates and exposing, having even less purchasing power. And, I always think about the buyers who are sitting on the sidelines. It's like, you don't even like the house that costs $630,000. How are you going to feel about the $530,000 home? Not to mention, there's no inventory the lower you go down the price spectrum. So, if you do want to get into housing and you got kids that you need to send to high school and all of that stuff, your brother-in-law could potentially be doing you a real disservice, because you'll be facing, I think, likely higher rates than what we have even right now. And you can see that here, right? That even as prices have slowed, and the statewide median price after hitting 900,000 has seen year-to-year growth kind of screech to a bit of a halt, and it's only going up 1.4% compared to where we were last August and September. But once you account for that increase in interest rates and you figure out what happened to the monthly mortgage payment, that's still growing by 35% year to year, right? So the increase in rates is way more than canceling out the effect of slower price growth. And I think that's important. Again, context, right? To not be so hyper focused on the fact that rates are at 7%, but like the cost of owning a home is continuing to go up by double digits, and is probably only going to get worse as we move forward, because again, the Fed is not taking their foot off the gas anytime soon. Does that mean we're kind of on the precipice and that your brother-in-law is right and just wait for the wave of foreclosures? To me, I think when you look at where we're at now through the lens of the just kind of hyper out of whack market with just so much demand and such little supply, I think we're less kind of dangling by the thread, as it were, and more just a market that's finally like catching its breath, right? That this is kind of exactly what my Econ 101 professor told me to expect to happen, right? That when you have so much demand, no supply, what you see is a surge in prices, all those inflationary pressures that we talked about, and that prices some buyers out of the market. It spooks other buyers. So demand kind of steps itself back, and sellers look around and see their friends selling homes quick, selling them for over asking price, and you get more supply coming online as well. So I think part of this is to be expected, right? And if we just, again, think about this through the lens of 2020 and 2021, where we had incredible growth, like, yes, we're down about 18% this year, right? That's the pink stuff. And you can see that really it's just because the top end of the market isn't growing by triple digits anymore. It's not like we have major changes under, 750. It's really just that, again, we're not having that just incredible growth. And guess what? When you grow by 22% and then you fall by 18%, you're still about 4% ahead of the game, right? So in some ways, this is just, again, a market that's coming back down to earth after having been out of whack for such a very long time. And you kind of see that same story here, right? And I think the Bay Area, which I just kind of picked on because it's a good microcosm of that, right? But that you look at the very high priced markets that were growing by 35, 40, 45% through the first 9 months of last year, they've started to give some of that back. But in most cases, the declines that we're seeing this year are smaller than the increases that we saw last year, right? And so again, some of this is just basic Econ 101 with a market that's normalizing after having been so not normal for a very long time. That being said, part of it is due to the Fed, right, and this war against inflation, and them constantly being behind the curve and having to come out and make up ground and really spook the market, spook the stock market. And I do think there's a good chance that they'll push us into recession. They're going to get inflation under control by the end of next year, probably, but it's going to come at the expense of the broader economy. Because if you look at where, the outlook is for rates, I think our forecast for 2023 is that the annual 30-year fixed rate mortgage is going to average 6.7%. But I also think there's a downside risk that the Fed won't be as successful in getting the inflation numbers under control, and also as they start to really unwind their MBS portfolio. The Fed was actually buying a lot of the mortgage-backed securities through this crisis, that we could see mortgage rate spreads open up a little bit wider than normal, meaning we could be looking at rates as high as 7.5, 8, maybe even higher in a kind of worst case scenario. Our kind of current forecast is 6.7%, again, meaning that we're going to start somewhere close to where we are now, right? Like high sixes, maybe maybe 7%, maybe go up as high as 7.5% in the spring of next year before the economy suffers a little bit and the Fed can kind of take their foot off the gas pedal and get us down into the sixes again by the end of the year. But you can see that already the impact of higher rates and the kind of increased price growth, the accelerated price growth that we've seen over the course of the last couple of years means that we're not able to kind of maintain that same level of first-time buyers, right? That we will see people qualify for less, and that will mean that some buyers at the margins are going to fall out. And I think you can already start to see that trend just from our 2022 annual housing market survey, where again, we still had relatively elevated levels of first-time home buyers. People certainly want home ownership, right? And we saw in all that kind of mortgage application, remote work, low rate kind of paradigm that passion for home ownership, I think, is certainly alive and well. This is more about the kind of mathematics of being able to make it pencil in an environment that shifted so much. But we shouldn't expect demand to fall off a cliff, right? Either, because we still are generating a lot of those high income jobs, right? Those folks who are insulated from the effects of the crisis now work at companies that are struggling to find people to fill all their remaining jobs, right? We have about 5.5 million more job openings than we have people looking for jobs. So it's not like these numbers are going to fall off a cliff, but affordability is deteriorated, and so increasingly we're just going to be relying on the very top end of the income spectrum to kind of carry the housing market forward over the course of the next couple of years. And yes, you can see that demand, at least in terms of mortgage applications, has kind of fallen off from those, again, decade high levels, right? That's the white stuff, is all the monthly mortgage application index, but it's not that scary compared to the way it looked back in 2018, 19. It's even still better than it was in 16 and 17, right? So again, even as this kind of market normalization is happening and you're seeing big, scary negative percentages, those are a function of the super incredible positive percentage growth that we were seeing in 2021. And so hopefully it now makes a little bit more sense why I was like belaboring what happened over the last couple of years, because I think, again, when you zoom it out and take these numbers in perspective, like, yes, in isolation, a negative 20% for transactions is scary, but in the context of a market that went up by 20% for a couple of years in a row there, it kind of helps you come down off the ledge a little bit and realize that part of this is just the market normalizing to something that will hopefully be a little bit more sustainable, because you just can't have 1.2 months of supply, 2.6% rates, and no, incredible demand, no supply combination just persist forever. Eventually you'd get to a point where no one could afford. The other thing I want to kind of point out, by way of just hopefully encouraging you or offering some relief, is that yes, even as we've seen the market not just normalize, but actually in July it fell to a kind of 12-year low for transactions, I think this is an overcorrection and a hypersensitivity to interest rates, right? That initial surge from 3 to 6% got everybody spooked. A lot of folks dropped out, but actually August sales numbers shot back up. Well, I wouldn't say shot back up, but they inched back up at least to 315,000 or so units. And I haven't released the September data, even though I'm showing it to you in this slide deck, but the September numbers stayed above 300,000 as well. And if you look at the really, really deep trenches for transactions, right, there's always some minimum threshold. Even in the worst financial crisis ever back in 2007 and 8, we were still maintaining transactions in the kind of 250, 260,000 range on a year-to-year basis, right? And the thing to keep in mind is that all of those life events that drive changes in the housing market are all still happening, right? People are still getting married, they're still having babies, they're still getting divorced and kicked out of the house by their wife and all of that stuff. You have multi-generational stuff and retirements happening, and so there is some minimum level. And because this is mostly an interest rate driven deal, right, where we've had this huge reduction in purchasing power that dropped a lot of buyers out of the market, I think there's a potential for the correction to happen relatively quickly, at least on the transaction side. We don't expect sales to start shooting back up, but I don't think we'll see the declines accelerate, right? That they're not going to keep getting worse and worse and worse. I think sales is definitely going to be the thing that kind of bears the brunt of this crisis, right? Because unlike last time, we had folks putting money down on these homes. We were really only originating mortgages to the most creditworthy individuals, and all of those folks, largely refied down to those 2.65% mortgage rates. Or there's, definitely a lot of folks camped out on 3% mortgages. And when you have equity in a 3% rate and you're still employed and making money at your high income job, you don't walk away from that home in the face of economic uncertainty. In fact, you probably just camp out and go into a kind of wait and see mode. And that's why I think we'll see sales rather than price bear the brunt of this, right? Because we're still going to have folks who want to buy homes, maybe not as much as we had the last couple of years, but I think inventory is going to remain pretty tight, right? The other thing is we have other sources of demand that are starting to come back into the fold. And you can see that the percentage of folks who went and bought investment property, and 4 out of 5 of those properties were bought to hold, right? And the flip numbers were going crazy in 2020 and 2021. But now we've seen the kind of buy, hold, and rent strategy come back, and that formed 14% of the market. And guess what? Investors don't really care that interest rates are at 7%, right? In fact, the kind of dynamic where the market isn't as competitive and you don't have as many other buyers to fight against, those kind of investor all cash buyer types certainly will have a leg up moving forward. And with affordability as terrible as it is, the kind of notion of owning rental property as we're sliding closer and closer to becoming a majority renter state, I think is something that we'll see kind of take some of the place of that lost kind of owner occupant first time buyer demand that we're going to experience over the next couple of years. This is data again for that 9, or I guess it's 12 county region that I mentioned before, but I just aggregated them all together. One of the things that I want to point out is that, yes, sales are down, but they're not falling off a cliff. In fact, this is weekly data that runs right up through the second week of October, and the numbers aren't falling off a cliff. They're definitely down from 2020 and 2021, but, again, they're not super scary from where we were. As demand has normalized, we also see that supply has started to normalize, and this is that same 12 county NorCal region. And yes, we have more homes available for sale, just shy of 10,000 homes available for sale on the MLS last week, which is the highest number that we've seen again for the last 3 years. But it's mostly because homes aren't selling as quick, right? That every week we're carrying more of those actives into the following week. It's actually not because sellers are headed for the exits, but nonetheless, this is, a market that is starting to normalize. We've gone from 8 days as a median time on market in NorCal back at the beginning of this year and for most of last summer up to 22 days. And that's a scary looking chart, but guess what? 22 days is still a very quick time. You're talking about less than 3 weeks to get your home sold. And just for context, my dad was a realtor in the 80s, 70s and 80s, and they would have absolutely killed for a 22-day median time on market. It just seems high relative to these hyper-depressed, hyper-competitive numbers that we were seeing last year, and similarly with the number of homes that are selling above list price, right? We've just gone from almost everything closing above list to just like 1 out of 3, which is still a high number, right? So, but the market certainly has shifted and is normalizing. I just kind of think it's helpful to interpret this through the lens of how crazy the last couple of years actually were, because it makes you feel better about where we are and hopefully makes you feel less scared about where we're going. This is going to play itself out, and you see that active listings and sellers, and Jennifer mentioned at the beginning, like managing expectations is so critical, right? And I think that's going to be one of the big challenges that we have, not just convincing buyers to have a longer view on housing and think about the wealth creation, the fact that rates are going to be higher in the future probably, and that prices probably aren't poised to come down much, but also to get sellers to come back to reality, right? Because I hear this all the time, that it's the kind of favorite trap of sellers to fall into, right? That they had a buddy who sold their home back in March. They got like 560 offers and they sold, 200% above list, and it went pending in like an hour and a half and all of that stuff. And then they, call their realtor now because they haven't realized that the market has shifted. They're extrapolating forward their buddy's experience from 6 or 9 months ago onto the current environment. And the reality is that, the market has shifted and more sellers are willing to reduce price. And so it's, again, this is where data is your friend, and you don't have to kind of opine on anything, but it's just like, let me show you what's happening to some of the other sellers, right? That they're not able to sell for, more than the list price as often. We should probably think about really right pricing this property, right? And if it's been sitting for a long time, and it's not just 2 or 3 weeks to go pending, but 2 months, 3 months, like, you might want to consider looking at the price, because that's what other sellers are doing. And you have a lot of emotions when you're selling a home. I know that firsthand, right? And you're like, what do you mean you want me to lower the price down, right? But if you draw a line in the sand, unfortunately, we don't operate in a bubble, and there's a whole market out there happening, and 42% of the other sellers have reduced price. And so again, these are the types of conversations that you're going to want to make sure that you're having on the front end, right? At the listing presentation, or even before, right? Is that this is why it's critical that we get the price right, that we have expectations, and that, that are kind of not based on a market that isn't there anymore. Even as I think that's the case, a lot of people see that as a problem. And I think especially for buyers, there's a lot of opportunity. If you want to be in home ownership and you want to get your foot on the property ladder, and you're one of those folks who have been, getting outbid, right? Or you couldn't get your offer in fast enough, or you had some kind of a like 10% down with PMIs that the seller didn't want to mess with, like, now's your chance, right? There's not as many buyers. Other buyers have dropped out. You don't have to kind of box out 20 other offers just to get your offer looked at. I've even heard of sellers like, doing rate buy downs. Like, if you don't have cash to be able to, pay a couple of points up front, you can get a seller to do that. That enables you to offer a higher purchase price and kind of finance in those rate buy downs and all kinds of cool stuff like that, so that the seller doesn't lose out, but the numbers can kind of pencil out for you. Those are things that were just not even close to being on the table over the course of the last couple of years. And I've actually heard that stuff happening recently. The other kind of thing I want to point out, not necessarily an opportunity, but maybe as a kind of counterpoint to the brother-in-law effect, who says that we're on the precipice of the next foreclosure crisis and everybody's going to let those homes go. Almost all of the mortgages that we've originated over not just the last couple of years, but the last decade, have been underwritten to an incredibly high standard, 720 FICO scores plus. Actually, from 2010 to like 2016, we were in a kind of 750 FICO score range. They started to loosen up, but you still needed to be like the cream of the crop when it comes to credit scores just to qualify, right? And I think that's why you see not just that we don't have a huge delinquency problem across the entire nation, but in California in particular, folks have really prioritized their homes, right? They might have let their cars go delinquent, or, went BK and that kind of stuff, but less than 3% of mortgages in California were delinquent as of the most recent survey during the summer of this year. And again, these are folks that put money down. They bought at relatively modest DTIs, right? They weren't buying homes that they couldn't afford. They were documenting their income. They were putting money down, and all of that stuff helps to insulate us. Some people will foreclose. And I even saw an article that said, foreclosures are up like 100% or something. It's like, yeah, we couldn't foreclose last year, right? So going from 0 to 1 is actually infinite growth, but it's still only a very small number. The other thing I want to point out is that even as active listings are up, right? And I showed you total actives. This is the number of new listings that we add to the MLS each week. So there's kind of the stock, right? The snapshot of what's available for sale. But then this is the kind of flow component of that, of how many did we actually put onto the MLS last week. And the reason, again, why inventory is up is just because those homes aren't selling as fast, right? It's not because sellers are headed for the exits and trying to cash in and dump these properties. And indeed, I think this is going to be both the thing that helps prices from falling very far, right? And we do have a modest price decline forecast for 2023, but why it's not 2008 all over again. These are high credit folks with equity and 2.65% mortgages. And so they're not going to throw that away. They're going to wait and see what happens. In fact, I think this is going to be a persistent challenge for inflation, or excuse me, for inventory going forward, right? Is like, who's going to want to move, even if it's 3 times too much house? I got this sweetheart mortgage rate, but that's also going to, again, help to insulate us a little bit from the downside effects that we're forecasting. Last point I want to make too, before I show you the forecast, is just that, you know, interest rates, even at 6.8, 6.6, that's still relatively low by historical standards. If you go back to the housing bubble in 2005, 6, 7, we had almost a 7% mortgage rate, and we were doing almost 500,000 transactions a year. During the dot-com bubble, we were doing more than 500,000 transactions a year, and we had almost a 9% mortgage interest rate. So it's not necessarily the level of interest rates that's particularly problematic. It's just a huge adjustment after, you know, that kind of decline down to these all-time lows of 2.65% got baked into the market prices, right? And so that is just this kind of adjustment process that we're going to be going through over the next 12 months. Not that the kind of level of rates in and of itself is going to be the thing that takes the housing market down. We do have a modest recession baked into our forecast, but it's only a modest recession. If you look at our number for US GDP growth next year, it's negative 0.5%, meaning that we're going to have couple quarters of negative growth. Consumers are going to do a pullback in the face of this inflation, higher rates, and the fact that they've really racked up a lot of credit card and car loan debt. But we should start to get back on track as we get towards the second half of the year, meaning that it's going to be a relatively modest recession. But we just kind of have to work out a lot of this excess stimulus that really pumped up prices and got everything out of whack. A lot of that stuff is starting to unwind itself. We have jobs going down a little bit, unemployment going up, but 4.4% is still relatively low for unemployment. So even as we're probably towards the more pessimistic end of the spectrum when it comes to the economy, my interpretation of this number is like, I feel like way more optimistic than what you're reading in the paper. You know, a negative 0.5% for GDP is kind of expected in the face of this rapid, you know, overly stimulated economy, and 4.4% is still relatively low unemployment. It's not about being scared. It's all about being prepared and helping your kind of clients cut through all the rhetoric and headlines to get that long-term perspective. Because yes, sales are going to be down almost 20% when the dust settles on this year, but prices will still be up about 6% overall. We do have sales kind of staying in that low 300,000 range, right? I talked about how we went down to 295. We're back up to 315. We'll probably see it go back down into the low 300s for a while there before it starts to creep back up, meaning that the overall number for sales will be down about 7.2% next year. We also have prices coming down after having, you know, been just so far out of whack, because people won't be able to qualify for the same numbers that they could, and the folks that still can qualify won't have to claw their way past quite as many buyers. That and the fact that we're not seeing 300% growth and 2 million and up helps to kind of bring that number down. I would say half of it is just the lack of excess growth at the top end. About half is like a decline in price per square foot in the low single digits. So again, it's not about what happens to your home in the next kind of 12 to 18 months. The beauty of home ownership is that it's the one and only way you accumulate wealth in this country, and that's well documented in the Fed's research. And so get them, you know, not focused in on the hyper aggressive, scaly, toothy, you know, monster that they don't know what's going on, and to kind of take that longer perspective, give them that context, give them that market data. We're not here to convince anybody to do anything. We're here to give them the information they need to make the right decisions. And that good, correct information often gets lost in the shuffle, especially in this kind of electronic age of all these scary emails that come in every day. So I think that's the recipe for success, right? That trusted advisor role is needed more than ever. I think they really, really need us, right? But the downside is that they kind of really, really need us, and that means that we've got to bring our A game. So I will leave it there and just say thanks again to Jennifer for having me, and thank you all for your time.
Thank you, Jordan. We really appreciate it. If you guys have questions, we'll answer a few here. I'm sorry, I'm hearing echo. Do you hear an echo on me?
A little bit. It's not too bad.
Hold on one sec.
Can you hear me okay now, Jordan?
I can hear you. Yep.
Great. So a couple questions have come in, and I've got a couple questions. You know, I think I hear all the time from agents about this, like how to help their buyers right now, right? The buyers on the fence.
Yep.
And I do think you brought up a great point about, you know, they're waiting for the prices to go down. I think a lot of people are making offers. You know, I talked to an agent the other day, they got 6 offers on a house. So there are still homes getting multiple offers.
Yep.
But, you know, 2 of them were at asking price, 2 were over, and like 2 were under. Right. So we've got buyers thinking there's deals out there. So, you know, while the prices that, you know, for 2023 indicated we might see a price decline, which so far we've not seen any of that. So that'll be new.
Yep.
But the interest rate increase maybe doesn't offset that. Right. So like, do you anticipate when we're going to see a price decrease?
I think we'll start to see it. I think we've already started to see it in some markets. And again, part of it is just due to how we measure prices, right? They're median prices. And so when I don't have 510 million and up selling anymore, then the median price just automatically goes down. Even if every house is worth more than it was last year, if you just don't sell all those ones at the top end, then that helps prices come down. I think the last couple months we've seen it kind of decelerate down into the low single digits, and so I think you're probably, you know, it's a 3 to 5 month process before we actually get into negative territory. But I think, you know, probably by end of this year, early next year, probably about coinciding with where the rate is peaking.
Okay, and then one thing too, I think it'd be good to talk about. You mentioned at the beginning we'll see a modest recession. I think sometimes, especially as it pertains to housing, when we hear the word recession, we think of like everything's falling apart, right? Like,
Yeah.
Can you just like the definition of a recession that make sure the agents know how to communicate that to a client?
Yeah, the best thing to say is that there is no definition of a recession. That's like the best response to that question, because the reality is, you know, and I know people say like 2 quarters of negative economic growth and stuff like that, and that tends to be one of the factors that they weight heavily. But the reality is, it's just the National Bureau of Economic Research is like the one bestowed with the powers of declaring a recession, and it really is whatever they say a recession starts. So if you go back to like 2008, they called it when unemployment started going up, not when we had 2 quarters of negative GDP growth. And so the answer is, it's just whatever they feel like. 2 quarters of GDP growth isn't a great sign. But the other thing that I would point out too, which I thought, I don't know who does Keeping Current Matters or not, but I'm like, Leslie works for Keeping Current Matters, like in a retirement now. So I'm a big fan of what they do. But they had a killer one pager that talked about home prices and recessions. And actually, it's, you know, the exception is when a recession causes home prices to go down, not the rule. In fact, you know, only the 2 out of the last, I think, 5 or 6 recessions actually came with price declines. One of them was the housing bubble, right? Because that was a housing driven downturn. The other one was the 1990s, when we had the whole S&L shenanigans and the trust busting and all of that stuff, you know, or the bank and trust stuff, the thrifts. And, you know, outside of that, the 80s downturn, the 2001 downturn, you know, the kind of more macro driven recessions usually don't have prices go down, because, you know, homes are one of those kind of inelastic goods. They're price elastic, right? As prices shoot through the roof, buyers step back, but they're not that very income elastic, because we all still got to live somewhere. And so, you know, that's kind of, I think, an important point, is that a recession doesn't always mean prices go down.
Yeah, but that's a great point. A couple questions that came in on the chat. So somebody asked that, great to hear that things are normalizing. I know Ryan had a town hall yesterday, and I think he highlighted the fact that like things are getting worse. And so I think part of that, like and you run into this all the time, there's national news, and then there's California news, and then there's Northern California news, right? So it all feels a little different. I do think, though, there's this misconception that, you know, the decline, when you say like the market's down 40%, like that's like gold, right? Like, that's super scary. But yeah, 40, yeah, you mentioned this, like being down from an overly inflated situation. But I think what Ryan was indicating, and what you had spoken about too, like we're going to keep seeing units fall. We're going to see some prices fall. So like, I think again, you just have to know what this means for your own client and their own situation, right?
Yeah. And you just got to be, we're going to be in a belt tightening mode, right? There's not going to be as many buyers. There's going to be buyers that are spooked and all of that stuff. And we can't just, this is definitely nose to the grindstone, right? It's not just, a bump in the road and kick your feet up on the desk and the listings will start pouring in and stuff. Like, we really got to be out there, being that trusted advisor, market expert role to help cut through all these scary headlines. And again, there's still going to be some minimum level of transactions, even if we go back down below 300,000, right? There's still 300,000 homes, meaning 600,000 sides. The question is, how many of those are going to be yours? And I think that's the approach to kind of take in these times.
That's right. That's right. Somebody mentioned in here, this is a perfect time for seller finance. You talked about a rate, the seller doing a rate buy down. It's like, oh yeah, like we forgot about all these like things we use, like strategies we had in a previous market, right? So
yeah, we forgot about all these tips and tricks and stuff. And actually, I think that's one of the, especially in the context of some of those numbers where days on market's going up, and you might have a seller who doesn't want to do a price reduction. It's like, what if I, spend $9,000 getting you down to 5.5% for the next 30 years, and you can offer me another $20,000 to make up for it on that, because you now qualify for more at this lower rate. Right. And so it's everybody kind of wins, right? And then you don't have to lower your price. In fact, you could get a higher price, and that might be like strategies for those ones that are sitting for a long time and they don't want to budge on the price. Well, it's like, what if we throw $10,000, at a rate buy down for these folks? I mean, that would be hugely attractive to somebody who's getting scared by a 7% rate, right? And we never know.
Absolutely. Absolutely. I do think, like you said, we have to think differently and we have to get creative and be really smart. I think, the two things I would just highlight as well, like, I know we have a lot of cash buyers in California, but your relationship with a trusted mortgage advisor right now, you need to be arm in arm with your mortgage professionals. And obviously we've got tons of great people through our connection with C.A.R, but whoever your trusted advisor is for mortgage, get them involved really early, because there are some things that make a big difference that we need to make sure our clients understand for sure. The other thing is make sure your connection with the colleagues in your office, navigating what's working and what tools you have. I know a bunch of our offices are doing great collaboration meetings and great sales meetings, more than ever, the group you are connected with in your office and throughout Northern California. And we'll probably do some more panels moving forward in fourth quarter, but really important to know what's working in different strategies, right?
100%. And, actually, I think as hard as as challenging, I won't say hard, but as challenging as the next year or year and a half might be, I think that a lot of folks are going to absolutely kill it, not just now, but if you do great in the next couple of years, I think, again, this is the time when consumers need us more than ever. Rates are going crazy. They're buying different properties. They might move up to Sonoma and get out of the city and stuff. They're buying in areas they don't know. And all the changes happening with the mortgage, and to make sure their deal gets done and that they're in at a rate they're happy with. I mean, you're going to not just do well this year if you can kind of really check that box. That's going to be your business for the next 10 years, because they're going to be like, this person was amazing, and I'm going to send every single person that I know to you, and the kids and grandkids. I'm going to buy every house I buy with. You know what I mean? And so as challenging as it is, even in 2008, right? A lot of people came out of 2008, 9, and 10 stronger than ever before, and they've thrived over the last 10 years because of that, what they kind of stepped up to the plate and were able to make happen in the challenging times.
Could not agree more. We did a mid-year check-in with all of Northern California, and I said then, and I still believe, when the market changes like this, when it goes through a transition, agents at Coldwell Banker that know how to take care of their clients better than any, this is your market. This is your market. It's really, really critical. So there was a question about the recording and the slides. Yes, we're going to share Jordan's slides and this recording. And again, we'll send a link where you can find some other great stats that C.A.R puts out. I know it looks like Claudia also shared the Keeping Current Matters, which they do a really great job. So the more, you don't need to absorb everything, but I think finding a couple key talking points that you can speak to, right, is everything. Let's see, a few other quick questions. Can you comment on the impact of the stock market declines on, how that's impacting the housing market, especially in Northern California?
Yeah, I think that's why you started to see the Bay Area in particular start to slow down a little bit faster. I mean, we're always kind of on the leading edge, right? When things were starting to go up nationwide, we were already like 6 months into our run, and same thing on the way down. We tend to be the like first ones to turn. I do think there's a wealth effect that has a big role in the local market, right? Because you've got folks that either work for these big tech companies and have options and stuff like that, or they're trading and they're in the financial services industry, and they're, not necessarily relying on those stock portfolios to go out and purchase the home, but when they don't feel as rich, then they, maybe kind of enter that holding pattern instead of going out and being bullish on their home in Atherton or whatever, and I think that is kind of where we're at. They're still doing great financially, right? They had a great run for many years, but there's just a kind of wait and see element when the stock market is volatile, because again, it's a wealth effect that I think, probably isn't as present in places like Bakersfield and stuff like that, where you got really low median prices. But these are folks who, are at the highest end of the income spectrum. They're the highest paid folks that California has to offer. And so I do think that there's a kind of exaggerated effect on places like the Bay Area from that stuff.
Yeah, and it's always hard. Anything that gets overinflated and then is a takeaway. It's like, it wasn't real, but it still feels painful, right? So
yeah, it's like if you get a 20% bonus last year and then you only get a 10% bonus this year, it's like, dude, that was still like free money. You know what I mean? But it feels like a letdown. So
totally. I know we're at like 1 minute left, but I'm gonna just run through some of the last quick things here on the chat. I love this question. In the least amount of words, what is a good response for how's the market right now? And I have a 2-word response. I don't know, Jordan. My response to how's the market is always, it depends. Like, yeah. Are you a buyer? Are you a seller? Are you an investor? Are you a renter? Like, it totally depends on what, when the market was amazing, however, like 10 months ago, it wasn't amazing for everybody, right? Yeah. And I will just say a really healthy market is one that is balanced. And so when you talked about months of inventory, like 5 or 6 months of inventory actually is a really balanced. We haven't seen that in like, I don't remember. Decades, it seems like decades, right? And so I think like how is the market really depends on what financial goals your client has and what's happening. Like, is it still a great time to sell? There's like, to your point, houses selling in less than 2 weeks. The best houses priced right are still moving fast, and many of them are getting multiple offers
and going over a list. Yeah, there's still 1 out of 3 selling over list. Again, it's just not 90%, right? So it's just, I think that's key. I would say, turn it around and ask the question, what's your timeline, right? If you're trying to buy and sell in the next 6 months, there's an enhanced risk, right? We're in a risky period of uncertainty and stuff. For a long-term standpoint, right? And I did a speech with an old-time realtor down in San Diego back in the day, and I loved his thing because he said the number 1 best time to buy a home in California was 20 years ago, and the second best time is today. And I think that kind of speaks to the long-term trend of prices in California, that we have ups and downs in business cycles, but fundamentally we're a state of 40 million people with not enough homes to put those people in, meaning that over the long term prices always go up. So again, it just comes down to, as you said, what's your timeline and what's your goals. So, but the idea of owning real estate in California, I think, remains unblemished by the most recent events. And I think it's high, even with a $2.1 million home price in San Mateo, I think 10, 15 years from now, we're going to be like, man, we should have bought when it was 2.1 million,
I know. Coulda, woulda, shoulda, right? Yeah. This question, what is the Fed's sweet spot inflation rate and where are we now?
They want to be at 2%, 2 to 2.5%. We're at 8 to 8.5% over the last 4 to 5 months. So they've still got a long way to go. I do think we're past peak inflation. I think we've already seen the worst, but I just think it's going to be slow and coming down, meaning that they're going to probably have to be more aggressive than what they're just overly optimistic about how good they're going to be at getting this thing dialed in. And I think so far their track record doesn't back that up.
Yeah. Is the unemployment rate, excuse me, misreading that, is the unemployment rate artificially low, do you think?
The unemployment rate, I don't think the unemployment rate is artificially low. I think that what happened was that the labor force shrunk because you had a lot of older folks during COVID, just early retirement out, and they just straight up are not in the labor force anymore. And so unemployment is low, and that's why we can't fill all those jobs, right? Is because we have just a huge chunk of like the most highest skilled folks who are, most senior positions that just totally, stopped working. And that's why I think, again, it's not going to be a huge decline. You still have a lot of companies that want to hire people and can't find the people, and so it's not going to be a free fall in employment, but I just think you'll see them not invest as much as fast, maybe, put some projects on pause and things like that. So we just won't have that kind of continued growth.
Yeah, absolutely. And then finally, could you talk briefly about the luxury market changes and your predictions there? Because that has been really unique, right?
Yeah. Actually, you'll see it when I send the slides around, but if you look at that one that shows 2020, 2021, and 2022 broken out by price segment, we were getting like 150% growth at those very highest categories last year. But if you look at and it was hard to see because last year's growth is so high, but if you look at those categories for this year, I think even 10 million and up is still up about 6%. It just looks like nothing compared to 150%, but it's actually still growing. It's just growing at a much slower clip. And again, people at the top end of the income spectrum continue to outperform everybody else, right? Their wages are going up faster. They've taken a bit of a stock portfolio hit, but the other thing that kind of counteracts that, and maybe why housing is staying strong up at the top end, is because it's a hedge against inflation, right? If there's a lot of inflationary pressures out there, you don't want to buy a government bond and lose all your money. Better to park it in some California real estate. And I think that's helping to prop up the top end too. It's just both the economics and the fact that it's a safe haven for your money at the top end.
Yeah, absolutely. Hey, Jordan, I cannot thank you enough. We had almost 1,800 people on this forecast call. So I appreciate your partnership and your friendship and your insights. We really, really enjoy having you with us. I'm sure we'll have you with us probably after first quarter next year and see how things are looking. And I know, like I said, you work so diligently behind the scenes every day to make sure that we're getting the information we need and advocating for us in our industry. So we appreciate you very much. Thank you to all of our Northern California agents for being here. We know how hard you are working to take care of your clients in these ever-changing markets, and the changes have been fast and furious. Stay tuned, reach out to each other, stay connected, and we will have more information for you in the coming months on how the market's doing. Thanks so much.
Thanks.